Welcome back, everybody. Today's Monday, November 11th, 2019. Today we're going to be going over Chapter 14, Partnerships, Ownership Changes, and Liquidations. So, before I get started on this chapter, I just want to go over a few things here. Don't forget the Chapter 13 homework. It was assigned last week. The Understanding the Issues 1 and 3 and Exercise 3 from the end of Chapter 13 is due today at 11:55. The homework solutions for that chapter are available here. Once again, use these as a key to guide yourself through the answers. Please attempt them before looking at it. And also, Chapter 14 homework is assigned. It's up and loaded in Moodle here, complete from the end of Chapter 14. Understand the issues 2 and 4 and exercises 1, 4, and 6. And these will be due next Monday at 11:55 as well. So with that being said, we're going to get into Chapter 14 now. Partnerships, ownership changes, and liquidations. So the learning objectives for Chapter 14 are to understand that changes in the ownership of a partnership do not necessarily result in the dissolution and winding up of a partnership. Account for partners' capital balances under the bonus method. Account for the partners' capital balances under the goodwill method. Describe the conceptual differences between the bonus and goodwill methods. And account for the admissions of a new partner through direct contribution to an existing partner. Explain the impact of a partner's withdrawal from the partnership. Describe the order in which assets must be distributed upon liquidation of a partnership and explain the right of offset concept. Understand the treatment for capital deficiencies and unsatisfied creditors. Calculate the assets to be distributed to a given partner in a lump sum or installment liquidation, and understand the concept of maximum loss absorbable. Prepare an installment liquidation statement and a schedule of safe payments. So changes in the ownership structure of a corporation are everyday occurrences, as evidenced by the activity of security exchanges. Now, in the case of a partnership, changes in ownership structure are events that require special accounting treatment. A transfer in whole or in part of a partner's interest in a partnership is permissible and does not necessarily result in the disassociation of the transferring partner, of the dissolution and winding up of that partnership. Now, the entity theory of a partnership suggests that the partnership entity should continue if a partnership is disassociated. Changes in the ownership structure of a partnership are also influenced by the propriety theory, which views a partnership as a distinct entity rather as a group of individual investors. Changes in the ownership structure of the partnership are presumed to be an arm's length transactions, which reflect the current value of the partnership. Such changes may indicate that previously unrecorded intangible assets exist that are traceable to the original partnership, and intangible assets such as goodwill exist that are traceable to a new partner. Now, in practice, a change in ownership normally suggests the need to both revalue the net assets and recognize intangible assets. Okay, admission of a new partner. The admission of a new partner requires the approval of the existing partners. Although a partner's interest may be assigned to someone outside the partnership without the consent of other partners. Now, assuming a new partner has been approved by the existing partners, the new partner will experience the same general risks and rights of ownership as do the other existing partners. The value of assets contributed to an existing partnership. So one method of gaining admission to an existing partnership involves contributing assets directly to the partnership entity itself. Now, an incoming partner may acquire an interest in the partnership for a price in excess that is indicated by the book value of the original partnership's net assets. This situation would suggest the existence of unrecognized appreciation on the recorded net assets of the original partnership, unrecognized goodwill that is also traceable to the original partnership, It is, however, possible that an incoming partner may acquire an interest in the partnership at a price less than that indicated by the book value. This situation would suggest the existence of unrecognized appreciation or write-downs on the recorded net assets of the original partnership, and or a contribution by the incoming partner of some intangible asset in addition to a measured contribution. When an incoming partner's contribution is different from that indicated by the book values of the original partnership, the admission of the partner typically is recorded by either the bonus method or the goodwill method. These two methods are mutually exclusive of each other, and both methods comprehend the possibility of adjusting the value of existing assets and the existence of goodwill. They do differ in how these conditions are recognized, however. So the bonus method. The bonus method generally follows a book value approach. That is, existing book values should not be adjusted to current values unless such adjustments would have otherwise been allowed by generally accepted accounting principles, otherwise known as GAAP. So therefore, when a new partner is admitted to an existing partnership, the total capital of the new partnership consists of the following: the book value of the previous partnership, less that of any write-downs in the value of the previous partnership's assets as recognized by GAAP, plus the fair value of the consideration paid to the partnership by the incoming partner. Now, the incoming partner's new capital balance is equal to the value of the consideration paid by the incoming partner less the bonus or increase in capital recorded for the original partners. Now, the difference between the value of the consideration received from the incoming partner and his or her capital balance represents the bonus traceable to the original partners. Now, the bonus may be either to the old partners or the new partner, and the bonus is going to be allocated based on the profit loss percentages, not interest and capital percentages. Bonus to the original partners. When an incoming partner's contribution indicates the existence of unrecorded assets, appreciation, and or unrecorded goodwill, the bonus method does not record these previously unrecorded items, but rather grants a bonus to the original partners. The bonus, which increases the capital accounts of the original partners and reduces the capital balance of the new partners, is made possible by recording in the new partner's capital account only a portion of the actual contribution to the partnership. Now, to illustrate this method, assume the following. So we can see the existing partners A and B here. Their capital balance is $30,000 and $40,000 respectively. The percentage interest in capital is 40% for A and 60% for B. And the profits are split at 50%. Now, this example is going to be used, this original partners A and B capital balances and percentage interested in capital and profit for the remaining examples through the duration of this chapter. Then assume that C invests $27,000 in the partnership in exchange for a 20% interest in the capital and a 20% interest in profits. The $27,000 of consideration invested by partner C in exchange for a 20% interest in capital suggests that the total value of the new partnership is $135,000. We know this because $27,000 divided by 20% gives us $135,000. So the $135,000 of value is comprised of the following. Book value of the original partners is $75,000. The investment of the new partner was $27,000, which leaves us at $102,000. And the asset appreciation traceable to the original partners is $33,000. And the total suggested value is $135,000. So the $6,600 difference between C's contribution and the interest recorded for C is going to indicate the existence of unrecorded intangibles or unrecorded appreciation on existing assets. Now, assuming the $6,600 is identified as a bonus to the original partners and is divided between them according to their profit and loss ratio prior to the admission of the new partner, the entry to record C's investment is as follows. So we'll debit assets for $27,000. We'll credit the capital to A, B, and C as follows. The $3,300 to A and B, and the capital for the new partner, C, would be $20,400. Bonus method to the new partner. Now, when the new partner invests some intangible assets, such as business acumen or an established clientele, it is possible to have a bonus credited to the new partner. Now, for example, given the same basic facts as in the previous illustration, assume that C invests $10,000 for a 20% interest in capital and a 20% interest in profits. Total capital of the partnership would be $85,000. We get this by the $30,000 plus $45,000 plus the $10,000. And C's share of total capital would be 20%, or $17,000. Partner C is acquiring a $17,000 interest in capital in exchange for an investment of $10,000. And the original partners are transferring $7,000 of their capital to C in exchange for unrecorded intangible assets invested by Partner C. Partner C's admission is recorded by the following entry. We'll debit assets of $10,000, debit capital for partners A and B at $3,500 each, and credit C, the capital for Partner C, at $17,000. Overvaluation of the original partnership. The recording of a bonus traceable to the incoming partner was based on the assumption that the new partner was contributing an intangible asset in addition to other assets valued at $10,000. However, the substance of the transaction may indicate that no intangible are being contributed to the existing assets of the old partnership are overvalued. For example, in the previous illustration, C invested $10,000 in return for a 20% interest in the new partnership's total capital. Therefore, the total capital of the new partnership may be interpreted from C's investment to be equal to $50,000. We get this by taking $10,000 and dividing it by 20%. Now, of this total, $10,000 is going to be traceable to the new partner. And the balance of $40,000 represents the fair value of the original partner's capital. Now, assuming this is a proper interpretation of the substance of the transaction that was between the new partner and the partnership, it suggests that the assets of the original partnership are overvalued by $35,000. We get the $35,000 because of the $75,000 less that of the $40,000. C's admission to the partnership is recorded as follows. We would debit the capital accounts for partners A and B at $17,500, credit assets of $35,000, and this is to accomplish recording the write-down of the original partner's capital from a book value of $75,000 to its implied fair value of $40,000. So that top entry is how we accomplish that, the write-down of the original partner's capital. Next, we'll debit assets of $10,000 and credit the capital account of partner C of $10,000. And this is to record C's contribution of assets to the partnership. The goodwill method. The goodwill method views the admission of a new partner as an opportunity to revalue net assets as though a new entity had been created. Had a new entity been created, the assets transferred to this entity would have been recorded at their current fair values. Now, the total capital of the new partnership will consist of the following values: the book value of the net assets of the previous partnership, plus the unrecognized appreciation or less unrecognized appreciation on the recorded net assets of the previous partnership, plus the unrecognized goodwill traceable to the previous partnership, plus the fair value of the consideration, both tangible and intangible, received from the new incoming partner. Now, when the bonus method is used to account for the admission of a new partner, the total capital of the new entity equals the book value of the previous partner's capital, adjusted for asset write-downs, if appropriate, plus the incoming partner's investment. When the goodwill method is employed, the total capital of the new partnership must approximate the fair value of the entity. Now, to illustrate the goodwill method, assume the following. If C invests $27,000 in the partnership in exchange for a 20% interest in capital and a 20% interest in profit, such an investment implies that the entity has a fair value of $135,000. We get the $135,000 by taking $27,000 and dividing it by 20%. Now, the book value of the new partnership equals only $102,000 when the former partner's capital balances of $75,000 are added to C's $27,000 investment. Thus, $33,000 must be added to the existing book value. Now, if differences between the fair value and the book value of recorded assets are identifiable, appropriate adjustments to asset balances should be considered. Now, assuming objective measures of unrecorded appreciation are available, the appreciation would be recognized and allocated to the previous partners according to their old profit and loss ratios. Now, to illustrate, assume that the $33,000 difference in values from the previous example is entirely traceable to the unrecognized net appreciation of the recorded net assets of the previous partnership as follows. We have land appreciation of $43,000 and an inventory write-down of $10,000, leaving a net appreciation of $33,000. Now, this appreciation and the investment by C would be recorded by debiting assets from C of $27,000, debiting land of $43,000, crediting inventory for $10,000, and crediting the capital account for partner A of $16,500, crediting the capital account of partner B for $16,500, and crediting the capital account for partner C for $27,000. Goodwill attributable to the original partners. Unrecorded goodwill may be identifiable. In the previous example, assuming there are no differences between the fair value and book value of recorded assets, the new partner's willingness to pay more than the proportionate book value of the new entity indicates that goodwill existed prior to the new partner's admission. The goodwill is recorded and allocated to the original partners according to their profit and loss ratio. The investment by C is recorded under the goodwill method as follows. We would debit assets from C of $27,000, debit goodwill of $33,000. We would credit the capital account for partner A of $16,500, credit the capital account for partner B of $16,500, and credit the capital account of partner C for $27,000. Now, the recognition of goodwill traceable to the previous partners is criticized by some accountants. If the concept of a new entity is cast aside, some would argue that the goodwill is self-created and therefore should not be recognized. Now, outside of partnership accounting, self-created goodwill is not recognized, and only goodwill purchased from another entity may be recognized. Asset write-downs. Given the same basic facts as in the previous illustrations, assume that C invests $10,000 to acquire a 20% interest in partnership of A and B. C's investment implies a fair value of the new entity equal to $50,000. We know this because 10,000 divided by 20% is $50,000. Now the book value of the new partnership equals $85,000, consisting of the original partner's capital balances of $75,000 plus C's investment of $10,000. This difference between the fair value and the higher book value indicates the existence of unrecorded net write-downs or goodwill contributed by the incoming partner. The amount of the suggested write-down is calculated by comparing the implied fair value of $50,000 to the $85,000, representing the book value of the previous partnership plus the new partner's investment. The difference of $35,000 is equal to the necessary net write-down. Now, assuming the net write-down is represented by land appreciation of $20,000 and the write-down of $55,000 to inventory, the net write-down would be recorded as follows. We would debit the capital account for partner A of $17,500, debit the capital account of partner B by $17,500, debit land by $20,000, and credit inventory of $55,000. Goodwill traceable to the new partners. Assuming net assets of the original partnership are properly valued and should not be written down, it is possible that goodwill may be traceable to the incoming partner. The amount of this contributed goodwill may be computed as the difference between the amount that should have been paid by the new partner, as indicated by the book value of the previous partnership, and the amount of consideration excluding any goodwill contributed by the new partner. Now, using the previous example, the $75,000 original book value would represent 80% of the new partnership capital, or $93,750, which is $75,000 divided by 80%. Therefore, it appears that the new partnership should have paid, or the new partners should have paid $18,750. $93,750 less the original $75,000 book value for a 20% interest in the partnership. The partner actually paid only $10,000 cash. So the difference between what should have been paid of $18,750 and the amount that was actually paid of $10,000 represents the goodwill traceable to the incoming partner. The investment by C would be recorded under the goodwill method as follows. We would debit assets of $10,000, debit goodwill of $8,750, and credit the capital account of partner C for $18,750. Revaluation of assets and goodwill. So the previous examples of accounting for new partners, investment assumed that either asset revaluations or goodwill recognition were appropriate as mutually exclusive choices. Now, in reality, some combination of the two may be appropriate. Continuing with the previous example, assume that the $75,000 book value of the previous partnership has a fair value of $64,000, and new partner C's investment remains at $10,000. The first step to be taken is to recognize the write-down of the previous partnership's net assets. So here we're going to debit the capital account of partner A by $5,500, debit the capital account of partner B by $5,500, and credit assets by $11,000. Now the adjusted value of the previous partnership then is used to determine the goodwill traceable to the new partner. In this example, the $64,000 fair value of the previous partnership would represent 80% of the new partnership capital, or $80,000. 64,000 divided by 80%. Therefore, it appears that the new partner should have paid $16,000, 80,000 less the fair value of the previous partnership, for a 20% interest in the partnership. So the difference between what should have been paid of $16,000 and the amount actually paid of $10,000 represents the goodwill traceable to the incoming partner. So the entry to record C's investment would be a debit to assets of $10,000, a debit to goodwill for $6,000, and a credit to C, the capital account of partner C, for $16,000. Methodology for determining goodwill. So an analysis of the previous examples reveals that goodwill may be traceable to either the original partners or the incoming partner. Now, to properly apply the goodwill method, the following methodology may be helpful in identifying the origin of the goodwill and its amount. So first, we want to determine the entity's fair value as indicated by the new partner's investment. We find this by the new partner's investment divided by the percentage interest acquired in the partnership. Second, if the fair value determined is greater than the book value of the new partnership, adjusted for net appreciation or net write-downs, implied goodwill is traceable to the original partners and is allocated among them according to their original profit ratios. The amount of goodwill is equal to the difference between the fair value indicated by the new partner's investment and the adjusted book value of the new partnership, less than the adjusted book value. If the fair value determined is less than the adjusted book value of the new partnership, implied goodwill is traceable to the new partner. The amount of goodwill is equal to the difference between the amount that should have been paid by the new partner to acquire an interest in the adjusted book value of the previous partnership and the actual amount paid. The third thing is the initial capital balance of the new partner always is equal to the new partner's interest and the total capital of the new partnership after goodwill is recognized. Contribution of assets to existing partners. A new partner also may be admitted to the partnership by acquiring all or part of the capital interest of one or more existing partners in exchange for some consideration. In this case, the new partner deals directly with an existing partner or partners rather than with the partnership entity. Therefore, the acquisition price is paid to the selling partner and not the partnership itself. The partnership records the redistribution of capital interests by transferring all or a portion of the seller's capital to the new partner's capital account, but does not record the transfer of any assets. So to illustrate, assume the following facts. Once again, it's the same facts of partner A and B's, capital balance of $30,000 and $40,000 respectively, and the percentage of interest in capital and profit are the same from the previous examples. Now assume a new partner C purchased a 50% of A's interest and capital and 50% of B's interest and capital in exchange for $50,000. So this purchase resulted in C's having a 50% interest in the total partnership capital. There are several alternative ways of recording the contribution of assets by C to the existing partners. So if the consideration paid by the incoming partner is not used to impute the fair value of the partnership, the transaction would be recorded by the partnership entity as follows. We would debit the capital account for partner A of $15,000. That's 50% of $30,000. We would debit the capital account for partner B for $22,500. That's 50% of the $45,000, which is these are their capital balances, partners A and B. And then we would credit the capital account for partner C of $37,500. Now the $50,000 actually paid by C was not used as a basis for the entry because it represents consideration paid to the individual partners personally rather than to the partnership entity. Now this accounting treatment frequently is compared to that of the corporation when a stockholder sells shares or an interest in corporate capital to another investor in the corporation. The corporation does not record the transaction or use it as a basis for revaluing corporate assets, but merely acknowledges the changing identity of its shareholders. Withdrawal of a partner. When a partner withdraws, the partnership agreement should be consulted to determine whether any guidelines have been established that would influence the procedure. The withdrawal of a partner requires a determination of the fair value of the partnership entity and a measurement of the partnership income to the date of withdrawal. So obviously withdrawal of a partner, we sell equity interest to an individual. Partnership entity records transfer of equity. Sell equity interest to the partnership. We have the bonus method in which the difference between existing partner equity and fair value. Remaining partners grant bonus to existing partner. Bonus charged according to the proportionate P&L ratio. Then we have the goodwill method for selling equity interest to the partnership. Payment to existing partner indicates the fair value of the partnership. And recognize goodwill only to existing partner or the entire entity. Selling of an interest to an individual. The equity of the withdrawing partner will be purchased with the personal assets of existing or new partners rather than with the assets of the partnership. Now assume partner A withdraws from the partnership and C uses personal funds to purchase A's interest at its current value of $36,000. If the price paid by C is not used to impute the value of the entity, the transaction will be recorded by debiting the capital account of partner A by $30,000 and crediting the capital account of partner C by $30,000. Selling of an interest to the partnership. When a withdrawing partner sells an interest to the partnership rather than to an individual partner, the bonus or goodwill methods may be employed. Now, using the same facts as in the previous illustration and assuming the use of the bonus method, the purchase of A's equity by the partnership would be recorded by debiting the capital account of partner A by $30,000, debiting the capital account of partner B by $4,000, debiting the capital account of partner C by $2,000, and crediting cash for $36,000. Now the entry indicates that the remaining partners granted a bonus to A, measured by the difference between the recorded capital and the fair value of A's equity. The bonus is charged to the remaining partners according to the proportionate profit and loss ratio. And we see that by the reduction in the capital counts and the relative partners in that entry. So the goodwill method focuses on the payment to the withdrawing partner as an indication of the fair value of the partnership. Assuming existing assets are properly valued, The $36,000 payment to A consists of A's capital balance of $30,000 plus a $6,000 share of the unrecorded goodwill. Therefore, the $6,000 represents A's 40% interest in total goodwill of $15,000. We get the $15,000 because $6,000 divided by 40% is $15,000. Notice that the $6,000 represents A's interest in the gain, which would be realized in the unrecorded goodwill were sold. Therefore, A's profit percentage is used to suggest the total value of goodwill. Two alternatives are now available. We could either recognize only the goodwill that is traceable to the retiring partner, or recognize the amount of goodwill traceable to the entire entity. The first alternative stresses the importance of recognizing only the amount of goodwill that actually is purchased from the withdrawing partner. Using this alternative, A's withdrawal would be recorded by debiting goodwill for $6,000, crediting the capital of partner A by $6,000, debiting the capital account of partner A by $36,000, and then crediting cash for $36,000. If the amount of goodwill traceable to the entire entity is recognized, the goodwill would be allocated to the partners according to their profit and loss ratio, as reflected in the following entries to record A's withdrawal. So we'll see that we'll debit goodwill for $15,000. We get $15,000 because $6,000 divided by 40% gives us $15,000. Remember, this is assuming as the entire entity is recognized. Goodwill traceable to the entire entity. So once again, debit goodwill for $15,000. And then we're going to credit the capital account for partner A for $6,000, credit the capital account for partner B for $6,000, credit the capital account of partner C for $3,000, debit the capital account of partner A for $36,000, and credit cash for $36,000. Partnership liquidation. The withdrawal or admission of a partner normally does not mean that the previous partnership is dissolved. However, the occurrence of certain events does result in the dissolution of the partnership and the winding up of its business. Now, here we'll get into some partnership liquidation guidelines. The underlying theme in accounting for partnership liquidation is the equitable distribution of the assets. So the settlement of accounts and contributions to partners. The RUPA establishes rules governing the priority in which partnership assets are distributed to creditors and partners. Subject to any agreement to the contrary, the following sequence must be followed. Assets of the partnership must first be used to discharge obligations to creditors. Creditors include partners who are creditors on parity with other creditors. Profits and losses, including those resulting from the liquidation, must be allocated to the individual partner's accounts. Therefore, upon allocation, such profits or losses become part of a partner's capital balance. A partner with a debit or a deficit capital balance shall make a contribution to the partnership of an amount equal to the debit balance. If the partner is not able to totally eliminate the debit balance, all other partners shall contribute the deficiency in proportion to the manner in which those partners share losses. If a partner contributes more than the proportionate share, he or she may recover the excess from the other partners. Liquidating distributions should be made to the partners to the extent that they have credit surplus capital balances. After settlement of the partners' accounts, each partner shall contribute in proportion to the manner in which they share losses. An amount necessary to settle partnership obligations that were not known at the time of the settlement. Although amounts due partners that represent obligations on parity with other creditors have a higher legal priority than amounts owed to partners as capital, the doctrine of right of offset sets aside this ranking in favor of procedural and economic considerations that facilitate the actual liquidation process. Now, this doctrine is not addressed in the RUPA, but may be incorporated in the partnership agreement. The effect of this doctrine is that amounts due to partners as creditors are combined with the respective partners' capital balances. Without the right of offset, it would be possible to distribute assets to a partner in payment of their creditor balance, while at the same time the partner has a debit capital account balance. Liability for debit capital balances. The RUPA states that the partners should contribute assets to the partnership to the extent of their debit capital balance. If such a contribution is not possible, the RUPA states that the other partners should make additional capital contributions totaling the debit or deficit balance. As a practical matter, the remaining debit balance will typically be viewed as a realization loss and allocated according to the remaining partner's loss ratio rather than requiring an actual contribution of additional capital. Now, under common law and federal bankruptcy law, amounts owed to partners by way of contribution are on an equal basis with personal creditors of the partner. Unsatisfied partnership creditors. In the winding up of a partnership, the first priority is to discharge the obligations of the partnership to creditors. If the partnership does not have the adequate assets to fully dismiss these creditors, the unsatisfied creditors must look to the personal assets of the individual partners. Prior to the RUPA, under what was referred to as dual priority, partnership creditors had first priority against the partnership's assets, and a partner's individual creditors had first priority against the partner's personal assets. Now, under Section 807 of the current RUPA, unsatisfied partnership creditors share pro rata with the partner's personal and individual creditors and the assets of the partner's estates. Therefore, the priorities under the dual priority rule have been eliminated and are now in conformity with current bankruptcy laws. Types of liquidation approaches. First, we have a lump sum liquidation, whereas all assets are in distributable form and all outside creditors are satisfied before the distributions are made to partners. Next, we have installment liquidation, which payments may be made to partners only after anticipating all liabilities, possible losses, and liquidation expenses. So let's take a look at an example of a lump sum liquidation. So if we look at this right here, we have the beginning balances of cash, non-cash assets. Cash is $10,000, non-cash assets is $120,000, liabilities of $80,000. Then we have partners A, B, and C's, their ownership interests or their interest in the partnership, 40, 40, and 20 respectively. So let's take a look here at the timeline here. First, from February 15th, we sell assets at a gain. So we receive $60,000 cash, and the assets, the non-cash assets, of $50,000. So the gain of $10,000 there will be allocated to the partners A, B, and C relative to their profit and loss ratios. Same thing, March 2nd, sell assets at a loss. So we receive $10,000 cash for $30,000 worth of non-cash assets, so we incurred a $20,000 loss. Once again, we're going to allocate that loss amongst the partners based upon their profit and loss percentages. Next, March 4th, we pay a liquidation expense of $2,000. Once again, allocated amongst the partners relative to their profit and loss percentages. On March 7th, we sold assets at a loss of $20,000. We received $20,000. The non-cash assets were on the books at $40,000, so we incurred a $20,000 loss. Once again, allocate the loss to the partners relative to their profit and loss ratios. Then we see here the claims against the partnership are paid in the proper order subject to the concept of the rights of offset. So what's that mean? We can see down here at the bottom, the payment of the liabilities of $80,000 is coming out of the cash account, reducing the balance to $18,000. The liabilities of $80,000 have been paid. Continuing on. B's contribution, because we know once that was taken care of, the $80,000, we see here on this line we have $18,000 cash remaining. No liabilities on the outside. We have a loan payment of to partner A of $9,000. He still has $12,200 in his capital account. B has a deficit of $2,800, and C has a deficit of $400 at this point in time. So B's contribution of $2,800. So B contributed $2,800 to cover his deficit. So that right there we see. So therefore B's deficit has been taken care of, no deficit. And now the cash went up from $18,000 to $20,800. We still see all things are the same for partner C. He still has a deficit of $400. We still have a loan payable to partner A of $9,000, and he still has $12,200 in his capital account. Next, you see here, back down to this line here, B's contribution, so that's where we left off at the last one. Now we're going to absorb C's deficit. So C didn't have anything in this case to contribute to his deficit, whereas B did on the previous example of the $2,800. So C does not have anything to give, nor nothing to bring to the table to the partnership. So the partnership is going to absorb C's deficit. So how is this going to take place? So as we can see here, B, he no longer has anything invested in here because he paid his deficit, so he's out of there. C, he's insolvent, so he can't do anything. He can't bring anything to it. So we're going to absorb it. So therefore, we're going to take it out of A because A still has $12,200 in the company. So he's going to absorb the loss, bringing his capital account down to $11,800. Then from this point, we'll still have $20,800 in cash. So this is all going to go. This payment is all going to go to A, the $20,800. So no more balances. There's no more cash within the partnership. There's no more non-cash assets. We don't owe any liabilities. But it's important to remember here that the $9,000 went for the loan pay to A. So that's where the first $9,000 went to. Then the rest of the $11,800 went to satisfy what he still had within the company. So that's how we do a lump sum liquidation. That's how the order of operations and how we go about doing that. Next, if we recall, the installment liquidation, payments may be made to partners only after anticipating all liabilities, possible losses, and liquidation expenses. So let's jump back down here to 38, the installment liquidation, the first phase of an installment liquidation. Once again, same facts here. We have the beginning balance, cash 10,000, non-cash assets 120, liabilities of 30. Then we have the loans payable to partner A, 5,000, and then we have their percentage of their beginning balance of what they have within the company between A, B, and C. Once again, on February 15th, we sold assets. We incurred a loss here. We received $40,000 cash. We have the assets, the non-cash assets on the book were valued at $60,000 of book value, so we incurred a $20,000 loss. Once again, allocate it to the partners relative to their profit and loss percentage ratios. Payment of liabilities of $30,000. So now our cash is going to be going down to $20,000 because we used $30,000 of it to pay the liabilities. So we can see here liabilities. We reduced the liabilities by $30,000, so we no longer have any liabilities. So we can see here, once we've paid liabilities and sold some assets, that we still have $5,000 of a loan payable to partner A. He still has $17,000 in the company. B has $47,000, and C has $11,000. Then again on February 17th, we distribute Schedule A of $10,000, and it's going to hit against partner B for $10,000. How do we come up with this $10,000? So let's take a look at Schedule A. So we have the combined capital and loan balances before distribution. Partner A has $22,000 because it's his loan to A of $5,000 plus his $17,000. B has $47,000 and C has that of $11,000. So it's a total of $80,000. The estimated liquidation expense of $4,000, 4,000, 2,000 of 10,000. So there's the liquidation, the distribution expense of the liquidation of $10,000. But then remember, we have to do the possible asset losses of the 24,000, 24,000, 12,000, at the total of 60,000, because unsold non-cash assets are assumed to be worthless for purposes of determining the safe payments to partners. So any non-cash assets that are on the books of the partnership are determined to be zero, are assumed to be zero in order to make these safe payments. So that's why we're removing the estimated liquidation expense from whatever the capital balances is from each of the partners based upon their partnership profit and loss percentages. Same thing for the possible asset loss. We're assuming that all $60,000 of the remaining assets here are worthless, so we're going to allocate those amongst the partners. So by doing so, the remaining balances for partner A is negative $6,000, B still has $19,000, and C negative $3,000. So to allocate the deficit balance, so obviously partner A has $6,000 is going to be absorbed by partner B, and the $3,000 of C is going to be absorbed by partner B as well. So that'll bring partner A and C out of the deficit, while at the same time reducing the capital balance of partner B down to that of $10,000. So the safe payment on February 17th is $10,000. That's why the $10,000 is being incurred by partner B, because he's the one with the most capital. So therefore, the balances after the distribution schedule, Schedule A on February 17th, will leave us with $10,000 cash, $60,000 left over in non-cash assets. We'll have still a loan due to A of $5,000, and then we'll have $17,000 of capital balance for A, $37,000 capital balance for B, and $11,000 for C. Phase 2 of the installment liquidation. This is just the last line that we had, so the balance after the payment on February 17th. So once again, on March 2nd, we sold some more assets. It was at a loss, obviously, because it shows we brought in cash of $15,000 and removed $30,000 worth of non-cash assets off the books. So we incurred a $15,000 loss here. Once again, allocated amongst the partners relative to the profit and loss percentages. On the 4th of March, we paid the liquidation expense of $8,000 coming out of cash, dropping us down to $17,000. And once again, this is going to be allocated based upon the profit and loss percentages. So then once again, we can see once we sold some assets and paid the liquidation expenses, we are left over with $17,000 in cash. We still have a remaining of $30,000 non-cash assets on the books. Still have a loan payable to A of $5,000, and then the relative capital account balances as follows: $7,800 for A, $27,800 for B, and $6,400 for that of C. So March 5th, the distribution, once again, of $17,000. That's based upon the Schedule B, which we'll get into in a moment. We're going to first apply the loan payment of A of $800, and the remainder of $15,800 of that, and then $400 to that of C. Once again, leaving the balances of non-cash assets after the $17,000 payment on March 5th of $30,000, and then the relative balances of the capital balances for the partners and loan balances as follows here. So let's take a look at Schedule B. How did we come up with this $17,000 amount right here? So once again, we have the combined capital and loan balances before the distribution of $12,800, because we have the $7,800 plus the $5,000 for A, making $12,800, $27,800 for B, $6,400 for C, totaling $47,000 of combined capital and loan balances before distribution. Remember, We do not count any of these non-cash assets. We look at them as being worthless for terms of making these minimum safe payments. So the balances before distribution right here, we're going to take away from that the possible asset loss of the $30,000 here. So we're going to take that away from the balances, and once again, it's going to be based upon their profit and loss percentage ratios. So once we apply that, the balances and safe payments will be 800, 15,800, and 400 because it's $17,000, and once again, relative to whatever the profit and losses are. So therefore, we can see here how we came up with those amounts. On to phase 3 of the installment liquidation. Once again, this is the balance after the March 5th payment. Right here, so the last line on the previous slide. So once again, on March 17th, we had another sale of assets. We received $20,000 for $10,000 worth of the book value of assets. So we had a $10,000 gain here. So obviously this is going to be allocated amongst the partners based upon their profit and loss percentages once again. Then the balances of cash, now we have $20,000 again, and we still have $20,000 of non-cash assets on the books. And we can see the relative capital and loan balances of the partners as well. Then once again on March 18th, we did a distribution per the P&L of the $20,000 cash. And as follows, important to know here, cash distributions were made in the P&L ratio. Partners A's 8,000 March 18th distribution of 20,000 times 40% was first applied to the loan balance. That's why we can see here the remainder of the original 5,000, the 4,200 right here is first applied to the loan balance, then to the capital balance, the remainder of 3,800. And then so on and so forth for partners B and C, 8,000 and 4,000 respectively. Then again on April 1st, we had another sale of assets. Once again at a gain of $4,000 because we received cash of $24,000. And we sold a book value of assets of $20,000. So once again, this is going to be allocated based upon the P&L ratios. So once again, now we have a balance of $24,000 of cash, no non-cash assets, and no liabilities. The loan has been satisfied for partner A. So now the final distribution of the $24,000 in cash will be based upon the P&L ratios as well, of the 96, 96, and 4,800. The final balance is that we have no cash remaining, no non-cash assets, no liabilities, and all the partners' capital balances have been satisfied. So that's an example of the lump sum settlement and or lump sum liquidation of a partnership and an installment liquidation of a partnership. This is going to wrap up chapter 14, dealing with the partnerships, ownership changes, and liquidations. Once again, recall that chapter 13 homework is due tonight by 11:55 p.m. Solutions are available. Chapter 14 homework has also been assigned. Once again, it's complete the following from the chapter 14, understanding the issues 2 and 4, and exercises 1, 4, and 6. Moving forward in this class, I'm not totally sure if I'm going to post the last 2 homework assignments that are available. I want to see what work everyone could do on their own. I might change my mind and post the solutions in advance next Monday. But at this point, I think that I just want to see what everyone can do on their own at this point. I feel that this content is a little easier than that of the foreign currency translations and dealing with consolidations and acquisitions and stuff of that sort. So therefore, I want to see what you all can do on your own on these parts of your homework. Homework grades are already strong, so it shouldn't have that much of a bearing on the grade. But so at this point, moving forward, I probably will not post the homework solutions prior to them being due. But then again, I might. So just keep your eyes out for that. But please do go ahead and attempt chapter 14 homework as it is due next Monday. So that's it for today's class. We'll pick up next week with chapter 20. and go from there. So everyone have a good day. Thank you for your time.